Have you ever spotted a perfect order block, set your entry, watch the price touch it, and then watch the market immediately dump straight through your stop loss, only to turn around 5 minutes later and fly 200 pips right to your target? Yeah, we've all been there. Welcome back to the Money Blueprint. Today we're diving into an explainer that uncovers exactly how institutions manipulate market structure, essentially using retail traders as liquidity. We're going to break down this blueprint and understand how to spot a trap called inducement, so you can stop being the bait.
The guide really sets the stage with a scenario we know all too well, right? You've done your homework, you've spotted that perfect order block, you manage your risk, you wait patiently, the price taps your entry, and then bam, it dumps right through your stop. And then, almost like magic, it reverses and flies directly towards your original target. Man, it literally leaves you feeling like the market makers are watching your specific screen, just hunting your stop loss. Well, here's the harsh truth that the authors point out. You didn't actually misread the trend. Your directional bias, it was 100% correct. You just entered at an engineered trap. You became institutional liquidity. You see, big players absolutely need that liquidity to fill their massive orders, and they know exactly where to find it, right where retail traders place their stop losses.
Section 1. The Institutional Liquidity Trap. The text highlights a seriously fascinating contrast in mindsets here. On one side, you have the retail approach, right? Buying breakouts, jumping into a trade the exact second price breaks above a high or touches that very first pullback. But market makers, they know exactly how retail traders think. They deliberately push price past those obvious levels. Smart money isn't buying the breakout. They are waiting patiently for that initial pullback, the inducement, to be swept, grabbing those stop losses before making their move.
So, the blueprint formally defines this concept as inducement, or IDM. It's basically a minor liquidity trap created intentionally by institutions to trick impatient early traders into entering way before the real move actually happens. A fundamental truth you have to accept about the charts is that markets simply do not move without collecting liquidity first. The inducement is that very first minor pullback right after a structural break. It leaves behind an order block that looks perfectly valid to the untrained eye, but make no mistake, it is entirely designed to fail.
Section 2. Decoding Market Structure, BOS versus CHOCH.
Okay, first up, let's look at the break of structure, or BOS. A true BOS basically signifies that the current market trend is continuing strong. Now, when price breaks structure, retail traders tend to panic a bit. They feel that FOMO, like they're missing out on the move, so they desperately look for the closest order block to jump in. And institutions? They absolutely count on this. That nearest, most obvious pullback after a BOS is exactly where they set the trap.
On the flip side, we have a change of character, or CHOCH. This happens when the market breaks its very first key valid low or high. That CHOCH signal is your early warning shot that smart money is flipping the trend entirely. But here is a critical detail from the text you absolutely must remember. To confirm a true CHOCH and not just get caught in a fakeout, you need to see a full candle body close past that level. A simple wick? No way, that's not enough. A full body close is what confirms the momentum has truly shifted.
Which brings us to Section 3, Anatomy of the Inducement Trap.
The blueprint lays out this trap sequence step by step for a bullish trend. Let's walk through it. Step 1. Price makes a strong push up and breaks a major high. Step 2. Price pulls back just a little bit, forming a minor low, and starts to continue up. Step 3. This is where retail takes the bait, marking that minor order block and placing limit buy orders. Step 4. Institutions slam the price down, sweeping right through that minor low. And finally, Step 5, they hit a deeper, completely unmitigated order block sitting underneath, and bam, the real move begins.
This brilliantly illustrates why you absolutely must ignore that first pullback. See that fake order block? That early minor pullback is the IDM trap. Don't buy yet. The real institutional buy zone is waiting patiently just beneath it, down in that deeper, unmitigated block. That lower zone right there is where the smart money is actually stepping in.
Next up is Section 4, Inducement versus Real Structure.
The source boils this all down to a few unbreakable rules to help you tell the difference. Rule number 1, the first low formed after a break of structure is always inducement until it gets swept. Just don't even second guess it. Rule number 2, in an uptrend, a true high probability order block absolutely must sit below the inducement level. And conversely, rule number 3, in a downtrend, a true order block must sit above the inducement level.
Memorizing these rules is going to be your key to reducing those frustrating false entries.
There's a quote from the text that really just hits the nail on the head. If your order block sits above the inducement level, you are standing right in the middle of institutional liquidity. Let me just repeat that because it's so important. If you are entering above the inducement, you are literally the bait being hunted. You're providing the very liquidity those market makers need to fill their true orders.
Let's look at Section 5, Smart Money Execution Blueprint. So how do we actually trade this? Here is the exact execution blueprint provided by the authors. Step 1, identify a clean break of structure. Step 2, locate that very first internal pullback and mark it clearly as your IDM. Step 3, actively ignore any order blocks sitting above that IDM line. Step 4, highlight the unmitigated order block or fair value gap sitting below the inducement. And Step 5, which honestly is the hardest part for most of us, wait patiently for price to sweep the inducement level into your deeper zone before you even think about entering.
The authors actually ask us to visualize the market like a glowing magnet. Once that minor swing low, the inducement, is formed, it acts as a massive magnetic force, pulling price down to clear out all those early, impatient buyers. You just have to let the market sweep that impatient money first. Only after you see that the inducement has been successfully swept can you step in and trade with true confidence before the real rally.
Now, if you want to dive even deeper into these specific concepts, the authors published fantastic daily written guides over at the moneyblueprintzero.substack.com. As the source material reminds us, you've got to protect your capital, respect the sweep, and build your blueprint.
I'm going to leave you with a final thought to mull over today. Have you fallen for the inducement trap before? I mean, think back to your recent trades. How many of those so-called bad trades were actually just you acting as early liquidity for the big guys? Drop a comment below if you've been caught in this exact trap. And hey, share this explainer with a fellow trader who really needs to see this. Stay disciplined, always wait for the sweep, and I'll catch you in the next explainer.